What's up, everybody? This is Misael Gonzalez. You're watching Wall Street Saturday, a show about God, investing, and stocks. Our show is for educational purposes only. We're not financial advisors. So go ahead and enjoy the show. Share it, like, subscribe, and hit the notification bell to be notified every time a new video comes out. Thank you.
Hello, everyone, and welcome to another episode of Wall Street Saturday. Today is February 26th, and we have a really interesting episode for you today. We're actually going to be answering one of your questions regarding some of our favorite ETFs to invest in. But before we get into it, I'm just going to start us off with a prayer. Dear God, thank you so much for this day, for us just to be able to be gathered together and talk about stocks, talk about what's going on in the world, and finance, and give advice, answer questions. I pray that today that you would be with the people of Ukraine, as many of them are under a significant attack from Russia. I pray for your peace, both physically, spiritually, and also mentally, and for all of their loved ones who may be in the U.S. And worried about them. I pray for that peace would come very quickly, and that this situation would be resolved, and you would give the leaders of Russia and Ukraine and the world wisdom to resolve the situation. I thank you for the conversation that we're about to have, and I pray that it would be glorifying to you and useful to our viewers. In Jesus' name I pray, amen. All right, so I'll just start us off with introductions. I am Joshua Trusty.
My name is Misael Gonzalez.
And I'm Josh Flores. So I'm going to actually share this question that came from one of my buddies here. This isn't the exact quote from my buddy here. He actually doesn't know that I have this up here, so hope he forgives me if he's checking out this video, but it's very evident that he has been watching at least one of our videos, because he brought up a question about UPRO and TQQQ. And it was funny that he brought this question to us, because this is obviously, like Josh had mentioned, one of our favorite ETFs to invest in. And so this question, and I'll read it here. People are fleeing the bottom third of the NASDAQ and other lists where companies have dropped an average 50%. They are simply rearranging money from failing blue chips to succeeding blue chips. Well, why are they succeeding? Ultimately, it's from people fleeing to what they feel is a sure thing. I'd be curious if one of us did a random sampling of these companies on these ETFs, 10Ks, if we'd find out that they have more or less been cutting costs to maintain growth, and their customer base has been stagnating in reality. There's a hard ceiling to increase profits in this scenario. Personally, I don't trust it. I don't know, have you checked in on any of these UPRO or TQQQ companies? So I just want to hand this off to the team. I'll leave this question up here a little bit. So any one of you guys just want to answer this?
Yeah, I'll answer like the last part of the question where it says, have you checked in on any of these UPRO or TQQQ companies? As a matter of fact, the answer is a resounding yes. In fact, we recently discussed Amazon and Facebook, and in the video called A Tale of Two Tickers, Amazon versus Facebook, where we discussed the recent earnings results of both companies. So yes, we have been checking in on them, and we have discussed the futures of those companies. Actually, I would say, in fact, that Amazon, as one example, is one company that is really focused on growth. In fact, let me actually share my screen here, so you can actually see how their earnings and revenue history has changed over time. So this top blue line is their revenue. And this is all from Simply Wall Street, by the way, an excellent website, and not a paid endorsement. I just like the website. So this top blue line here is their revenue per year. And you can see it's pretty consistently going up, but has gone up substantially right around 2020 when the pandemic started. And their earnings, which is the light blue line, or kind of greenish blue line here at the bottom, that's also been steadily increasing. But what's really key in this chart is the purple line, which is their operating expenses. And their operating expenses have actually been pretty consistent throughout time. Yes, they've been increasing a little bit throughout the pandemic, but this is largely really consistent. So as you can see, the gap between their revenue and their operating expenses has just been increasing, which is a good thing, because it means not only are they making more money, it's not because they're cutting costs. In fact, they're increasing their costs, but they're increasing their costs to get more and more revenue. And their cost efficiency does appear to be increasing. So, and Amazon is also one of like the larger holdings of TQQQ. So this one it's going to have a disproportionate effect on the overall ETF. So at least with Amazon, and it's also true for many of the other companies that are part of TQQQ, they're not actually cutting costs to increase like their growth, because obviously that would limit their long-term growth, because you can only cut costs by so much. If your costs like somehow hit zero, which is unrealistic, but that's like the floor for how much you can increase your earnings growth by cutting costs. So Amazon is actually having organic growth, which is a good sign.
Yeah, and I'll bring this question back up just because I kind of want to answer a little bit on there, because he was talking about cutting their costs and things like that, which I think has a little bit to go with their profitability, and he mentions that too. And of course, profitability is not just like the only indicator for a company. I don't want to step on anyone's toes here, but obviously look at Zoom, look at Peloton. Those were like huge pandemic plays, and they had great profits. Both of those companies are obviously hurting, and they're struggling to get revenue and even cutting costs. And I don't even know if cutting costs would even be possible for a lot of these companies, considering the inflation and just like the demand that for paychecks now and just regular goods and raw materials. But there's a number of things that we look at, and like Josh had mentioned about bringing up Amazon, UPRO and TQQQ, like those are indexes. They're just triple leveraged. UPRO is the S&P 500. TQQQ is the NASDAQ. You can obviously see that in TQQQ. I mean, QQQ, Invesco, NASDAQ, and that T, to me, I just always remember it means triple QQQ. But yeah, and another thing that he kind of points out is this rearranging money. And yeah, the market does work in rotations. I mean, we have a finite set of money in our world, right? Especially like the US dollar. I mean, you've seen what happened when they print money. We can't just keep printing money. So there is a finite set of those dollars. And with that being said, that means that we have to be mindful of where we put those dollars, right? And so that's why we've seen things we saw in 2020, people were rotating into cryptos, right? And then 2021, people were rotating into those blue chips that he's talking about. And why? And the question is, why are they succeeding? And it's because the price of a stock is driven by the supply and demand. So obviously if you have a company that only has 2 shares of stock and one of them is open, obviously the price is going to be very high because the supply is very limited. And that's a very, very basic example of that. But yeah, and like you'd mentioned, yeah, we have looked at the 10 Qs. I mean, I think that Apple, Microsoft, and Amazon, maybe Google are like the highest weight to the S&P 500 and maybe even the NASDAQ. And so that's why if those companies are doing good in a day, it might reflect how the general market is doing. I know I've been kind of speaking a lot. I don't know if you have any thoughts on that, Misael.
Yeah, I think it's a question. If you can bring that question back up. Well, first of all, thanks for sending your question in. We would like to answer any questions our viewers may have in our videos just like this. And we'll link the video that Trusty was mentioning, the Tale of Two Tickers, in the description. Basically, I think he's having a question of, like Trusty was saying, the fixed cost model versus the variable cost model. And basically, I mean, a company, there's 2 main categories of companies: the value companies and the growth companies. Growth, the value that their share has on the market is based on future cash flows and not necessarily the cost, because obviously when you start a company, your costs are way high, and you're actually, a lot of them start by losing money. A lot of these companies, for example, at Tesla, for a while it was unprofitable. It was losing money because it was starting to lay the groundwork for production and things like that. And if you go over to something like a value company, and I think a lot of these blue chip companies fall into that category. Blue chip companies are well established. They have consistent cash flows. Their operating model is very clear. Their market is dominant. I think those companies don't cost cut costs to increase their revenue. I think that I think it's more brand recognition than anything else, and that's what keeps people coming through the door. We are seeing a shift in capital, like Josh Flores was saying. There's a finite amount of money, and people have to rearrange their priorities based on their risk profiles. Obviously, these companies that were safe back in 2021, 2020 aren't safe anymore because of their exposure maybe to the banking system was taking a hit because of the Russia invasion, or maybe they had direct ties to Russia. Maybe they're, for example, I heard this week that Volkswagen, right, was thinking about shutting down one of their plants because they can't get parts that were being produced in Ukraine, you know? So then money is going to move away from those companies, and it's going to move into companies that aren't directly related to Russia at all. Maybe like your consumer staples, your Costco, your Walmart, stuff that's grown here in the country, and it's pretty much hedged against Russian impact. So I think that's a good question. I don't think it's a matter of companies failing as much as it is just the global political scenario environment at the moment that is causing these shifts to happen. And that's natural. That's good, because people are trying to, like, at the end of the day, I think preventing losing money is better than actually making money. That's like the first rule. Keep the money that you have, don't lose anything. And if you can build upon it, that's great. So there's definitely a lot of shifts. Stay invested. This is a long-term thing, especially for us. And make sure you keep watching the show so you can be updated every time we have something new.
Yeah, one of the things that I wanted to almost kind of end on is asking Josh to kind of go into a little more detail about UPRO and TQQQ. I mean, I would do it myself, but I can't take credit for finding this ticker symbol. So Josh, do you think you can explain a little bit more about UPRO and TQQQ?
Yeah, so UPRO is kind of like SPY. So SPY is an ETF that represents the S&P 500 index. So you can essentially invest in that index through SPY or through UPRO. The difference between like those two ETFs and why I like UPRO the most is because UPRO is triple leveraged. So if, for example, SPY goes up by 1% in a single day, UPRO will go up by 3% in that same day. That's because they use not just stocks, but they also use like derivatives, like options, futures, what have you, as a way of amplifying the effect of your money. So if you can handle that kind of like volatility, you can actually end up making more money in the long term than you would with something like SPY. So UPRO is a really good way of getting more exposure to SPY or to the S&P 500 index than you would normally. And TQQQ does pretty much the exact same thing for the NASDAQ. So it's basically the NASDAQ, but just triple leveraged. So I like these two different ETFs as a way of getting more bang for my buck, so that I can just like every single dollar that I spend will be moving a lot more than it would if it was just in the overall S&P 500 or in the NASDAQ without any leverage at all. And I would rather invest in that sense versus investing in options, because these two different stocks or two different ETFs won't say like go to zero after an expiration date. They're in an ETF, so you can essentially wait as long as you need to for them to succeed. And they will eventually, because they are investing in the overall market. So I'm a huge fan of them, and I would encourage everyone just to look into them and consider if these different ETFs would be right for you. So I'm staying long in them, and I think you should too. Stay long, stay green.
Hey guys, thanks for checking out the video this week. If you haven't already, please like the video and subscribe to the channel. Every week we're going to be uploading a couple of videos every Saturday of opportunities that you can take advantage of in the markets. Thanks again, and have a happy trading week.